everybody? It's Tortoise Investing coming at you today for something a little bit different. I'm going to be taking a look at a stock that I love, tell you what I love about it, and I'm going to take a look at a stock that I dislike and show you what I dislike about it. So I guess this is really a way of how I analysis a buy and how I analysis say I'd never touch this stock with a 20-mile pole. Now, if you're new, please hit that subscribe button, hit the like button. Those two things are super free, super easy to do. It helps me out a ton, and I greatly, greatly appreciate everybody's support. Now, without further ado, a stock that I love, Texas Roadhouse. Take a look at the stock price here over the last 5 years. Pretty good. Not too bad. Year to date, it did have its little high there of 117. Down 18%. Whoa, what? My eyes, that's a buying opportunity. None of this is financial advice, by the way. What I like about it. Okay, we're going to take a look here. Adjusted free cash flow yield, 2.73%. Dividend yield, 2.29%. Payout ratio, 46.6%. Green flags all around. Revenue, very nice. Just consistent growth, 12% over the last 10 years. EBITDA, very nice, consistent growth, over 11% in the last 10 years. Free cash flow, this is the big one. This is the biggie. So your free cash flow is 15.84% over the last 10 years. But we're going to add in stock-based compensation. And as you can see here, it's not too big of an issue. And we can look here at stock-based compensation adjusted free cash flow, still growing. It's awesome. Love it. Net income, as you can see, is the same story. EPS, right at 15%, 14.7 over the last 10 years. They have more cash than debt. Awesome. Super big green check mark. Dividend's been increased at a rate of 16.4% over the last 10 years. That's just crazy. It's compounding at its finest right there. Shares outstanding. The last year they have been buying back shares, which is nice. 2018 they had 71.96 million, down to 67.92 million. So not too much to write home about, but they are nibbling at it slowly but surely. And the return on capital employed, the average is usually around 9 or 10. They had their 2020 hiccup, but right back off to the races, 15.56% in 2021, 17% in 2022. Operating margins, pretty consistent across the board. Very nice. Profit margins, consistent across the board, but slightly growing. Very good. You would probably look at this company and be like, that's a pretty good company. And I like it. Now, what I don't like. Roblox. Now, if you have it, if you like it, that's fine. I just don't. There's so much about this that I don't like. Take a look at the stock price here over the last 5 years. The high of 134, November 19th. You are currently down right at 77%. Right at 77%. Year to date, not too bad, 11% up. Just free cash flow yield negative 4.46%. No dividend. You might take a look at the revenue. This is the thing that's so deceiving. A newer investor might look at this and be like, what? They're increasing revenue, the rate of 55% over the last 2 years. That's crazy. Look at that. Look at that big jump there. Look at all that money. But if you dive deeper into stocks that are like this, they tell a different story. So we're taking a look at this EBITDA. That's going the wrong way. You don't want that to be doing that. Maybe the net income's a little bit better. Nope. EPS, maybe a little bit. Nope. Not looking too hot there. Yeah, you're getting diluted on your shares. They are adding more shares. That's not good. Return on capital employed, maybe? No. Operating margins? Negative 41 per, nope. Profit margins. No, nope. Still miss there. Expenses are going up. And the big thing is this. Oh my God. Look at that stock-based compensation in 2022. We're going to take a look here quarterly. This is stock-based compensation per quarter. And this just makes me just like, why? What are you doing? So, as from December 31st, 2021 till now, they have been giving out more stock-based compensation than they make in free cash flow. And there have been quarters where they have negative free cash flow here. And this is just growing. This is growing while this is declining. And this is quarterly. So this is like updated as of June. It's getting worse. Stock-based, free cash flow for adjusted for stock-based compensation. Not good. Not good at all. I'm not against a company giving out some stock-based compensation for their employees, for their management. I get it. But when you have to dive in to the profits of the company, when you made money in a quarter, but did you really? Because you gave out twice the amount in stock-based compensation. You have like one free cash flow positive quarter. Over the last 4, you had 1. I just don't get it. I don't get it. Again, if you own the stock, that's fine. I'm not like sitting here telling you that you're wrong. It's just I personally wouldn't touch it for all of these reasons. Like, none of this looks good, and they're actually diluting you even further. It looks like the stocks, yeah, they've been increasing the amount every quarter because they keep issuing shares out to the employees, and that's diluting the shareholders. And look, they've even took on some debt here. So it wouldn't surprise me if in the future like their debt's more than their free cash flow. You're sitting there, it's like, oh, look, you got more cash than debt on hand. Everything else is just screaming. It's like, no, I can't. Anyways, yeah, this is a quick little video. What I look for, what I like, what I avoid. Hope you enjoyed that. As always, hit the like and subscribe button if you're new. And until next time, see yous.